Hi, my name's Eric. I'll be reading you selections from Barron's magazine with an issue date of July 20th, 2026. This is produced by the Audible Local Ledger, a reading service exclusively for people who are blind or print disabled. We'll start with Up and Down Wall Street. Silicon Valley legend Michael Moritz on just about everything by Andy Sertwer. Like many of America's buzziest commercial centers, Silicon Valley is mostly populated by people from away. Even those well-scrubbed Stanford University MBA bros usually turn out to be corn-fed Iowans or some such, never mind the thousands of techies of Indian and Chinese descent trying to create the next new thing. Michael Moritz isn't to the Bay Area born either. More precisely, the free-thinking former head of prominent venture firm Sequoia Capital is, in his own words, 100% an Ashkenazi Jew from Wales. Talk about a category of one. It's that otherness that's prompted Moritz to write a memoir, Auslander, that's German for outsider, about his family, some escaping Nazi Germany to the United Kingdom, others being murdered, and him coming to terms with it. But the book is even much more than that. It's really a metaphorical life quest meditation by a terrifically smart guy who is also a professional writer. Moritz is quite the character, parts polymath, Zelig, and the most interesting man in the world, like the guy in the Dos Equis commercial. The former Time magazine correspondent is a noted philanthropist, knighted by Queen Elizabeth, a civic activist, a hotelier, a media publisher, a painter, Oxford University and Wharton School of the University of Penn grad, the richest Welshman, sorry Tom Jones, and yes, a world-class investor. Moritz led Sequoia from 1995 to 2012, stepping down when he slithered unconscious beneath the table during a meeting and was diagnosed with a rare blood cancer, which he says is now in remission. Touch wood. When Moritz was at Sequoia, he helped the firm invest in mega home runs like PayPal, Yahoo, LinkedIn, and Google. He was on all of those companies' boards and currently is a director of Klarna Group and Formation Bio. What does he think of the venture capital business today? It's become very difficult because there's such an enormous amount of money flowing in, everybody from sovereign wealth funds to individuals, Moritz says. Aspects of it resemble participating in an auction business. Returns come down. What does Moritz make of the artificial intelligence revolution and the massive investments in data centers made by big tech? Well, it's extraordinary, he says. I don't think anyone at the helm of these big companies ever thought they were going to be operating a massively capital-intensive business. If everybody's being honest, they've been caught by surprise by the enormous, unheralded acceleration by AI in all its various guises and aspects, whether it's some of these private companies, the explosion of data centers that drain the power grid, fears about employment, and the impact of these new technologies on pretty much any field. Is this troublesome? Without a shadow of doubt. I think this will be like every preceding changing of the guard in technology, where 2 or 3 extraordinary companies emerge and there'll be a lot of roadside casualties, he says. If capital dries up for some of the smaller companies, they're not going to have many alternatives but to either fold themselves into something larger or fall by the wayside. The other understandable aspect of this is the attention. Much of it is unflattering, on the concentration of wealth among a few individuals and the concentration of market cap in a handful of companies. I don't know if there's ever been such a concentration before, and the private companies that have these extraordinary market caps nobody ever dreamed would occur. Obviously, that's a source of great tension with politicians and the broader public. What about SpaceX and Elon Musk? Whatever varied opinions people have of him, it's hard to think of an industrialist in America who's been as successful as Elon. He's in a class of his own, and he has pretty stiff competition, Moritz says. As for the very high valuation of SpaceX and Tesla, Moritz offers some context. There's no precedent for the growth of some of these businesses, he says. Similar things were written about the valuations of Facebook or Google or Microsoft. I remember when Microsoft went public and everybody thought the $400 million or $500 million valuation for the company was ludicrous. His take on OpenAI's Sam Altman, I'm going to take the fifth on that, he says. I think Ronan Farrow's piece in The New Yorker was spot on. In Auslander, Moritz has little sympathy for big tech CEOs and their fealty to President Donald Trump. For me, one of the sorriest sights of this administration was the spectacle of several leaders of large technology companies serving as a backdrop at the inauguration and subsequently responding to his every whistle. I know that most would have preferred to be elsewhere, but were responding to an invitation that they couldn't refuse, lest Trump turn the power of the state on their companies. It's why they make frequent cameo appearances in the Oval Office, where the revolving cast of characters reminds me of the improvised meetings Tony Soprano once convened on the sidewalk outside Satriella's pork store. I'm sure they, despite their babysitting services, don't think, unlike the heads of German companies almost 100 years ago, that they can keep this man with all his brutish impulses under their thumbs. Paradoxically, as Moritz's excoriations of Trump lead him to comparisons with the rise of Hitler, Trump's America also has led him to obtain German citizenship, as he feels discomfort in the United Kingdom and the U.S., where he already holds passports these days. I think the lesson I've learned is that you can never have enough passports. Note, though, that Moritz is that rare public figure today who's speaking out publicly against both Trump and the Democrats. Over the past 30 years, California has been a very hostile, inhospitable place for business and for wealthy, successful individuals, he says. We have a state with one of the highest tax rates in the country. You have the highest unemployment figures in the country. You've got the most expensive housing in the country. You've got the highest homelessness rate in the country, and a shocking record in literacy and educational standards in the public school systems. The government of California has failed its citizenry in a frightful fashion. Many large corporations and wealthy individuals have turned tail and said, life's too short to stay in California. We want to be in a place where we feel welcome. Moritz, though, is making a stand in San Francisco, where he's lived since 1981. I'm deeply involved in trying to help San Francisco get onto a better footing in several ways, he says. My wife and I have a family foundation called Crankstart, with about 60% of its grants going to the San Francisco Bay Area. In the foundation's latest annual filing, it reported disbursing $205 million and having $4.4 billion in assets. I started the San Francisco Standard with a gentleman called Griffin Gaffney, which I'm pretty involved with. You can't have a thriving city without a high-quality local media business, he says. Moritz says the site's editorial slant is right of centrist, reflecting his own politics, but says the reporters are completely free range. And he says, I'm a big fan of San Francisco Mayor Daniel Lurie, and I'm trying to help him as much as I can. Unlike so many others, you've chosen fight instead of flight, I say to Moritz. Yeah, but I'm going to be 72 fairly soon, he says, and I'm not sure if I enjoyed similar material circumstances, and I was 30 years younger, that if I enjoyed similar material circumstances and I was 30 years younger, that I would stay. Moritz has plenty of other pursuits besides trying to save California, like working on Borgo Pagano, a countryside hotel in Tuscany, as well as a city hotel in Florence that he and his wife Harriet own. He also paints, which he took up later in life, just like Donald Reagan and George W. Bush, he points out, after reading Winston Churchill's essay, Painting as a Pastime. He occasionally writes opinion pieces for the Financial Times and is working on his second book with Alex Ferguson, the legendary manager of the soccer powerhouse Manchester United. Moritz's own investing is done mostly through HRTG, renamed from Sequoia Heritage, which was founded in 2010 to manage the wealth of Sequoia Partners and others. HRTG has $27 billion of assets in a concentrated portfolio of mostly private, non-venture-like companies, often in mature, unglamorous industrial businesses for long-term compounding, he says. I was curious about Moritz's earlier career at Time Inc. I worked there for 29 years, where he co-wrote a book about Lee Iacocca in his heyday and another about Apple and Steve Jobs. The Little Kingdom, the private story of Apple Computer, the latter indirectly propelling him into the venture business. Moritz was assigned to write a story about Jobs as part of Time's Man of the Year, as it was called then, feature for 1982, which turned out to be the PC as Machine of the Year. That greatly irked Jobs, who thought he'd been selected. To make matters worse, Moritz says his piece was turned into an unfair, unflattering, salacious, gossipy story about Steve, which made Jobs even angrier, and Moritz similarly upset and let down by the magazine. He quit Time, wrote a newsletter for a bit, and then went to talk to some leaders of VC firms and was offered a job in 1985 by Sequoia founder and legendary VC Don Valentine, a key early investor, ironically enough, in Apple. I think once you're a journalist, you're always a journalist, which is why I pick up the pen now and then, he tells me. Journalism taught me a lot about being a venture investor. As a journalist, you drop into a story about which you know nothing. You've got to quickly collect your wits and talk to as many people as possible. You try to assemble the narrative, knowing you have imperfect information and that people are trying to pull the wool over your eyes. There are many comparisons with that and with trying to figure out whether to make a venture investment. So, could any old journalist do what Moritz did? I'm pretty sure that's a category of one. With a look back, we'll move on to review and preview with what happened last week and what's supposed to happen this week. Odyssey versus World Cup. Shades of Barbenheimer. In July 2023, movie fans were torn between the simultaneous release of two blockbusters, Greta Gerwig's Barbie and Christopher Nolan's Oppenheimer. Now they're faced with another epic choice, Nolan's The Odyssey, which hit theaters Friday, or Sunday's World Cup final. A survey from Just Watch has a slight majority favoring The Odyssey, but 59% say they plan to watch both. Nolan assembled a cast of A-listers in his retelling of Homer's Odyssey. The film, costing $250 million, is the first shot entirely on IMAX cameras. The buzz is extraordinary, says Stephen Galloway, dean of the Dodge College of Film and Media Arts at Chapman University, and former executive editor of The Hollywood Reporter. They're going to have a huge hit on their hands. The big question is, will it beat Oppenheimer? That film grossed $975.7 million worldwide. Domestic estimates for the Odyssey's debut weekend range from $100 million to $125 million, which would make it the third largest 2026 debut behind Toy Story 5 and the Super Mario Galaxy movie. IMAX says the film will help it post a record $1.4 billion in 2026 global box office. Hollywood's box office sales this year through July 12th were $5.15 billion, up 10.7% from a year ago, on pace for the best year since 2019, notes Rentrack. Roth senior analyst Eric Handler says Nolan's films have staying power, and The Odyssey could ultimately quadruple its opening weekend sales. Still, the World Cup has Messi. And that was written by Janet H. Cho. Last week in markets, the U.S. and Iran ceasefire crumbled, and global stocks fell as oil prices hit 4-week highs. On Monday, SK Hynix sank over 15% in Korea. President Trump reimposed the Iran blockade and said the U.S. would charge 20% for safe passage through the Strait of Hormuz, and then walked the toll back. Inflation cooled to 3.5% in June. Stocks rebounded on artificial intelligence hopes, and then fell on Thursday as Chinese startup Moonshot AI released a competitive model. Chips sold off hard on Friday. On the week, the Dow Industrials fell 0.9%, the S&P 500 1.6%, and the Nasdaq Composite 2.9%. In companies last week, in a parting shot from Tim Cook, Apple sued OpenAI for stealing trade secrets. JP Morgan Chase and other big banks reported record results fueled by trading. A dozen states, led by California, sued Paramount Skydance on antitrust grounds for its acquisition of Warner Brothers Discovery. New York became the first state to place a moratorium on new data centers. IBM warned on profits as software sales took a hit from AI. Shares plunged 25%. SpaceX saw its stock fall beneath its offering price. Then it had to abort a Starship launch. In deals, Nippon Paint offered $8.6 billion for Agco Nobel's paint business in the face of an earlier offer from Axalta Coating Systems. Reuters reported that Stripe and Advent International made a joint $53 billion bid for payments processor PayPal. And Uber Technologies is buying Delivery Hero for $14.8 billion. This week, on Wednesday, July 22nd, Google parent Alphabet and Tesla are the first of the Magnificent Seven tech stocks to report this earnings season. Alphabet was one of only two Mag 7 stocks to fall in the week that ended July 10th, when big tech had a resurgence, and the stock, along with many other big tech names, weighed on the market this past week. Alphabet has suffered several high-profile losses recently as other artificial intelligence companies have poached its talent. On Thursday, July 23rd, the Department of Labor will release initial jobless claims for the week ending July 18th. Economists expect 215,000 people to file for unemployment benefits, up from 208,000 in the prior week. Recent employment readings have suggested a labor market that's cooling, but remains relatively steady, despite concerns about companies' increasing use of AI. However, job seekers have reported fairly sour sentiment. And on Friday, July 24th, the Census Bureau will report new home sales for June, after a downbeat surprise for existing home sales. That metric dropped unexpectedly month over month, the National Association of Realtors said earlier this month. Existing home prices hit a record high, and mortgage rates remain elevated, creating serious obstacles for home buyers. By the numbers: 10%, the amount of global refining capacity currently not operating, some 8.4 million barrels a day. 11%, the fall in second quarter year-over-year global smartphone shipments, the worst quarter in 13 years. 71%, the rise in exports of Chinese electric vehicles in June from a year earlier, some 1.1 million vehicles. And $100 billion. How much more Taiwan Semiconductor plans to invest in U.S. chip output, bringing its total to $265 billion. On to the articles from the columns. IBM faces a long road back to relevance. The blue chip stock's biggest wipeout on record will force the company to reinvent itself. Again. Is it up to the task? By Mackenzie Tatanani. IBM has been forced to reinvent itself many times in the past. After its biggest wipeout on record this past week, it will have to do so again. Big Blue had been riding high. Yes, there were problems in consulting as signaled by Accenture's woes, and in software, tipped off by weakness in ServiceNow and its sector peers. But IBM stock was trading at a record high as recently as June 2nd, as investors looked at the company's near monopoly in mainframes, its quantum computing effort, and its prospects as an artificial intelligence winner. They were wrong. IBM stock tumbled 25% this past Tuesday, its worst single-day drop on record, following a rare pre-announcement of its quarterly results. Such a move is highly unusual for the company, which is traditionally disciplined when it comes to financial reporting. The last time IBM pre-announced earnings was in October of 2008, in an effort to reassure investors that it was on track to meet targets during the global financial crisis. Investors faced a different reality this time around as IBM posted second quarter earnings and revenue that missed Wall Street forecasts. While there were plenty of problems, slowing software and consulting sales, a massive reallocation of technology spending by its customers to chips, servers, and other AI needs, the biggest drag on its performance was its infrastructure business. That includes its legacy mainframes. the massive computers that enterprises like banks and credit card networks rely on to process billions of calculations and transactions in real time. Big Blue is undoubtedly the dominant force in mainframes. A 2022 study by Celent, commissioned by IBM, found its Z mainframe servers line processed more than half of the world's transactions by value. But that didn't help the division's performance during the second quarter. Infrastructure revenue fell, as expected, but the 7% decline was significantly faster and harder than IBM anticipated. Not only did fewer companies buy mainframe hardware, but they also bought less high-margin software required for tasks like banking and credit card payments. CEO Arvind Krishna attributed the results to poor execution. We did not adapt and move quickly enough, and numerous large deals failed to close on the timelines we expected, driving the majority of our shortfall, he wrote in a letter to shareholders. The 25% drop was massive and partly justified, even as it erased nearly $70 billion in market value. The stock had become a crowded AI infrastructure winner, was trading near all-time highs, so any sign of execution issues was going to get punished, says Dan O'Regan, managing director of equity trading at Mizuho Securities. That said, a move of this magnitude suggests the market is now pricing in a much more prolonged slowdown than what management has implied. It didn't help that analysts had set high expectations. Morgan Stanley, for one, had predicted upside in infrastructure and software that was already priced into the stock. Oppenheimer, which downgraded the stock on Wednesday, had anticipated no surprises in business trajectory and was blindsided by the pre-announcement. Analysts were quick to move to the sidelines after IBM's earnings miss, asserting that Big Blue would have to lean on major acquisitions or close deals that slipped past the quarter's deadline to recover lost ground. Now, Oppenheimer is questioning the company's ability to achieve double-digit software revenue growth through 2027. The 5% growth in the latest quarter was sharply below the firm's 12% estimate. The bigger issue might be whether IBM's infrastructure business itself is being disrupted. Even before Tuesday's plunge, IBM stock had been lagging behind the broader market after stumbling earlier in the year as fears of AI disruption began to take hold. One of the most significant drops occurred in February, when AI startup Anthropic unveiled a COBOL modernization playbook for its Claude code tool, claiming that it could dramatically streamline updates to the outdated programming language that runs on IBM mainframes. Historically, the immense complexity and cost of migrating off these systems protected IBM's highly profitable mainframe business, a protective moat that AI now threatens to dissolve. IBM stock closed on Wednesday at 16.54 times 12-month forward earnings. That's its lowest price-to-earnings ratio since June of 2024. But that says less about where IBM is now than where it was before. As recently as June 2nd, the stock was trading for more than 25 times, above the S&P 500 index's 21.52, a premium valuation that might not have been deserved. Lower prices make an asset more attractive, says BNP Paribas's Stefan Slowinski. I just caution investors that out of all the companies I cover, IBM probably has the lowest organic growth currently and the lowest organic growth outlook. That needs to be reflected in the valuation. Slowinski, one of the most bearish voices on the street, rates the stock underperform. As tempting as it may be to buy shares after such a tumble, IBM still has a lot of work to do. In the worst-case scenario, investors fear that IBM's enterprise clients, massive businesses with sprawling information technology setups, are redirecting their budgets toward AI instead of Big Blue's traditional offerings. At best, IBM was caught off guard by a sudden CapEx shift, as Krishna asserted, and can reclaim lost ground in coming quarters. As Mizuho's O'Regan sees it, the setup from here depends less on the AI narrative and more on management proving it can consistently execute. The market wants proof that this is an execution stumble, not the beginning of a structural slowdown in demand, O'Regan explains. As a stock, the days of getting the benefit of the doubt are probably over for now, at least until the next metamorphosis begins to take shape. Our next article, in Barron's magazine from July 20th of 2026, Subaru stock deserves some investor love. Subaru cars have a cultish following. The U.S.-listed shares of the cash-rich company look like a bargain, trading below $8. By Andrew Barry. Subaru has developed a cult following in the U.S. with its rugged all-wheel drive vehicles like the Outback and Forester. If only its stock had the same following. Many investors don't realize that the Japanese automaker is publicly traded, with a market value of $11 billion. The U.S.-listed shares of the cash-rich company look like a bargain, trading below $8. The stock is down about 25% this year, and more than 50% during the past 10 years. For Subaru customers, buying a car is like a political or religious experience, says Cole Smead, lead manager of the Smead International Value Fund, which holds the stock. The company's marketing campaign is built on what the automaker calls its Subaru Love Promise, which reflects its vision to show love and respect for everyone. It was early, for instance, in courting the LGBTQ community. Smead says the stock has potential to double or triple, not on love, but on business merits. It's a better business than many investors appreciate. And the stock is cheap on earnings, and certainly book value, says Matthew Fine, manager of the Third Avenue Global Value Fund, which holds the stock. The weak stock price reflects a profit drop in the company's latest fiscal year, caused by U.S. tariffs and higher material costs. The stock trades for about 10 times projected earnings in the company's fiscal year, ending in March 2027, and for about 70% of tangible book value. The U.S. shares are reasonably liquid, with average daily volume of more than 300,000 shares a day. Like the stocks of many smaller foreign companies, it trades on the OTC markets rather than the New York Stock Exchange or NASDAQ. Subaru's price-to-earnings ratio is consistent with the low valuation of other global automakers. A couple things are going right for Subaru and distinguish it from its Japanese peers. Subaru sees financial improvement in the current year and has set a goal of doubling its return on equity to 10% by 2030. Which would translate into much higher profits. Current earnings are half of what the company generated in fiscal 2025. Subaru has a great balance sheet. It's sitting on about $6 billion of net cash and equivalents, or more than half of its market value. Like many Japanese companies, Subaru is getting more shareholder-friendly. When the company reported full-year results in May for its fiscal year ended March 31st, it indicated that cash levels wouldn't rise further. And it set a buyback for almost 10% of its stock that it plans to complete in the current fiscal year, ending in March 2027. It also pays a 4% dividend. Sooner or later, Fine says, Subaru may be acquired by Toyota Motor, its largest shareholder at 21%, and its manufacturing partner, as part of what Fine sees as needed consolidation in the fragmented Japanese auto industry. The consolidation would be Toyota and Honda Motor, which each have relationships with different affiliated automakers. Toyota's aligned with Subaru, Honda with Nissan. Subaru's better positioned than its Japanese rivals because it has virtually no exposure to China. The company gets 70% of its annual vehicle sales, of about 900,000, in the U.S., and it produces about half the cars sold in the U.S. from an Indiana plant. The company's U.S. market share is around 4%. And it's higher in the Pacific Northwest and New England. Its share in Vermont is above 10%. The company's done a good job of refreshing its car lineup, including an overhaul of its Outback crossover SUV this year and the introduction of a Forester hybrid in 2025. Subaru has kept prices reasonable on key models, with the Crosstrek base price unchanged in the 2027 model year at just under $27,000. One sign of Subaru's appeal is that it doesn't need to advertise much, like Tesla. Japanese automakers are under pressure from technologically advanced, low-cost Chinese competitors like BYD that are taking share throughout the developing world. Fine says another plus with Subaru is that it lacks a captive finance unit to offer loans to car buyers. JP Morgan Chase provides that financing. BMW and other big automakers keep large amounts of cash on their balance sheets to support their finance businesses, something Subaru doesn't need to do, and that gives Subaru more financial flexibility. Subaru had earmarked substantial capital expenditures to develop electric vehicles, but scaled that back when it moved to partner with Toyota on EVs. Fine says that was a right move, given the limited demand for EVs in both the US and Japan. Subaru's customer base is skewed toward rural areas where range issues with EVs are an issue for buyers. Subaru's Trailseeker EV is generating minimal sales, fewer than 1,000 cars in June. Fine points out that the Subaru Forester's specs, size, engine, and price, are comparable with the Toyota RAV4, as well as the Honda CR-V and Nissan Rogue. It makes little sense for different Japanese automakers to be selling very similar vehicles, he argues. If it merged with Toyota, Subaru could operate far more efficiently. Toyota is a much larger company that sells about 10 million vehicles annually and has a market value of $250 billion. Few car companies have the brand loyalty of Subaru. Investors can buy shares of the car maker at a bargain price at a time when Subaru is more focused on shareholders. There's a lot to love about Subaru cars and its stock. The next article headline, Williams stock is no AI pipe dream. Electricity-hungry data centers play right into midstream energy operator Williams's wheelhouse, making its stock a buy, by Teresa Rivas. In 2006, Alaska Senator Ted Stevens famously oversimplified the internet as a series of tubes. That may have been a gross misunderstanding of what was cutting-edge technology at the time, but today a series of tubes, i.e. pipelines, are helping to power the latest advancements, to the benefit of their stocks. Midstream operator Williams Companies handles roughly 1/3 of all the natural gas in the U.S. every day, connecting it from where it's produced to where it's used. It's one of the latest beneficiaries of artificial intelligence, as the company helps to provide some of the juice that increasingly electricity-hungry data centers require. That demand, along with the broader growth in electricity needs in the U.S., means the company has a plausible line of sight to robust profits for years to come. Williams has articulated an expectation for potentially 10% earnings growth through the end of the decade and even beyond. 8 to 10 years is sort of the time frame, says Ben Cook, portfolio manager of the Hennessy Midstream Fund, which owns the shares. That's not hard and fast guidance, but a company's ability to project double-digit earnings growth into the end of the decade is pretty unique. Most analysts are on board too. The consensus calls for Williams's earnings per share to climb 12.5% this year to a record $2.36, followed by more than 7% next year. Likewise, Wall Street sees gross margins ballooning to over 80% in 2026, and then remaining in the high 70% range. Not many companies can do what Williams does. It's created a durable competitive moat, rooted in regulatory and permitting complexity that's difficult to replicate, says Ian Owens, associate portfolio manager at Ball & Gaynor, which owns the shares. He cites assets like the Transcontinental Gas Pipeline, which spans more than 10,000 miles over multiple states. Fixed-fee contracts with investment-grade counterparties provide cash flow predictability, enabling the company to fund both shareholder returns and growth capex from contracted revenues, Owens says. Fixed fee is another way of saying Williams gets paid for the use of its pipes whether or not natural gas is flowing through them. That means that, unlike other energy companies, it's less susceptible to commodity price swings, and it knows it has enough money coming in to cover necessary investments. Some of those are around AI. The company has a differentiated integrated power platform, as Owens puts it, which has positioned the company as the first mover in on-site energy generation solutions for data centers. Big tech companies like Facebook parent Meta Platforms, which worked with Williams, are more than happy to pay for systems that allow them to bypass the grid and avoid blackouts. The company's data center contracts can be a decade or longer in duration, adding some certainty to its income. This past week, a group led by Blackstone said it would invest $5.34 billion in Williams to fund 5 major power infrastructure projects, in exchange for a 49% non-controlling equity interest in the projects. The company has a multi-billion-dollar backlog spanning more than a dozen projects. Cook notes that Williams' BBB investment grade rating gives him confidence that its balance sheet and steady cash flows are adequate to cover the investments it's making in the business. Nor, he says, do you have to be an AI believer, since export capacity for liquefied natural gas is expected to roughly double in less than 10 years. That comes after the U.S. went from almost zero LNG exports in 2016 to becoming the world's largest supplier. Williams shares have gained about 25% year-to-date, easily ahead of the broader market and even the tech darlings tracked by the Roundhill Magnificent 7 ETF, which has underperformed since the start of 2026. The stock trades at a little under 30 times next year's earnings. Still, Williams can boast sector-leading growth expectations with minimal risk in terms of natural gas prices. Steady earnings power that many investors feel is worth paying up for, according to Owens. The stock has been a consistent winner as well, soaring some 170% over the past 5 years. The company may have another catalyst if it acquires integrated natural gas player Momentum Midstream from private equity firm NCAP Flatrock Midstream. The industrial logic for the acquisition is there, as Haynesville represents a significant source of U.S. natural gas growth, notes Truist analyst Gabe Dowd, who says the shares should trade to $84, corresponding to upside of 13.5% from the current price of $73.96 should the deal go through, depending on the financing details. Williams pays a dividend of 52 cents a share, or about 2.9%. If investors think Williams has overpaid for any final deal, of course, they could sour on the shares. Likewise, although the stock is more insulated from natural gas prices than other players, it isn't totally immune to them, and the same is true when it comes to the AI trade. And then there's the fact that its valuation requires strong and consistent execution over time. Yet Williams executives have been good stewards of capital in the past, as the company's current balance sheet and capital position show. If the stock does sell off on debt-related concerns around a deal, the weakness would likely be temporary, and the long-term bull case for natural gas, for both regular power generation needs and AI projects, seems supportive of the commodity's price. The next article, in Barron's of July 20th, NFL players targeted in scheme using fake Shopify stores. The alleged scam, organized by a 24-year-old from Philadelphia, offered athletes ownership of bogus websites as a place to park cash from their lucrative careers. By Jacob Edelman. Earlier this year, e-commerce site Daily Prod Trend recorded a $5,000 order from a customer in Luxembourg for 100 desktop humidifiers and 120 USB-powered cup warmers. It was the latest in a long list of purported sales at the seemingly thriving Shopify-powered website that broke some basic rules of internet marketing. Daily Prod Trend doesn't appear in Google search results, and its web address is a random string of numbers and letters. In fact, it isn't meant to be seen by shoppers at all. A Barron's investigation found that Daily Prod Trend appears to be built on a ruse that uses Shopify, a leading platform for creating and running web shops, to mislead website proprietors into thinking they own successful online businesses. An internal dashboard for Daily Prod Trend shows a long list of orders, Barron's analysis suggests they're fake. The buyer for the humidifiers and cup warmers doesn't actually exist. Who needs 100 humidifiers and 120 cup warmers, says the person who lives at the address where the items were supposedly sent. The arrangement that clients now call a scam was organized by a 24-year-old burgeoning entrepreneur from Philadelphia named Mohammed Koulibaly. It has largely victimized professional athletes who are offered ownership of the bogus websites as a place to invest cash from their lucrative careers. The athletes in this case seem to have ignored red flags, urged on by an internet culture of get-rich-quick schemes. Koulibaly's social media feeds project an aura of wealth, success, and influence with a powerful network of athletes, entertainers, and executives. In his Instagram feed, he boards private jets, he rides on yachts, and relaxes in a limited edition two-tone Maybach. It's been a draw for a vulnerable group. Athletes earn the bulk of their lifetime income when they're young and lacking in financial experience, says John Hayes, managing director of MAI Capital Management in Cincinnati. You haven't yet had your hand next to the stove to know that it's hot, says Hayes, who works with athletes as clients, but yet you have millions of dollars. An Ernst & Young report in March found that athletes had been defrauded out of nearly $1 billion over the 2 decades through 2024. Players are being victimized at increasing rates as more money flows into professional sports through surging fees for media rights, merchandising campaigns, and partnerships, the study found. Earlier this year, a former Morgan Stanley advisor was convicted of defrauding NBA players out of more than $5 million by marketing them life insurance policies at inflated markups. One former athlete who lost money with Koulibaly told Barron's that the apparent scam had caused distress among players who had been counting on him to grow their nest eggs. Everybody doesn't know if they're going to get their money back, says the athlete who owned a now defunct Shopify site called Lux Lane through Koulibaly. People are scared, and Koulibaly is spelled Coulibaly. People are scared. 3 former National Football Association players interviewed by Barron's, including the Daily Prod Trend and Lux Lane owners, collectively say they lost more than $1 million across separate investments with Koulibaly. Barron's reviewed the Shopify interface for Daily Prod Trend and confirmed that an online order appeared on the site's dashboard without triggering a shipment. The effort appears to use a Shopify tool that allows merchants to create manual entries in the software's ledger for offline transactions. Seemingly fake entries include sales of motorized water guns, handheld electric fans, and smartphone cases. Shopify declined to comment. Zach Edwards, a cybersecurity expert who reviewed the dashboard at Barron's request, says the site has all the signs of a scam. Nothing about this passes the smell test, said Edwards, a threat investigator at digital security firm Infoblox. It's a really clever way to use Shopify's good reputation to launder a fraud. It isn't clear whether or how many other investors have been duped by similar fake sites, but the names of about 24 current and former pro athletes and other public figures are named as clients on a pitch deck viewed by Barron's that Koulibaly has circulated to potential investors. The athlete owner of Lux Lane says that Koulibaly had what appeared to be $25 million in a business account that Koulibaly showed him on a cell phone screen. In a recent interview with Barron's, Koulibaly described his e-commerce operation, Motion Ventures, as one part of his business. He wore sweatpants with a logo from Motion Apparels, a fashion label he sells online. Professional athletes invite me around because they like the energy that I bring, he says. The business portfolio that I have makes it a lot easier for these guys to want to be around me as well. The 3 athletes who spoke to Barron say they were reassured by their peers' connections to Koulibaly, as well as the involvement by Steve Kame, a former general manager of the Arizona Cardinals football team, who is operations chief of Koulibaly's e-commerce venture. Because why would someone of Steve's stature get involved with something that wouldn't be real? the Daily Prod Trend owner told Barron's. When contacted by Barron's in May, Keem initially declined to comment without first securing Coulibaly's permission. He later said in a text that he had received the entrepreneur's approval but hasn't responded to subsequent messages. Coulibaly's circle has also included executives at Fanatics, the $31 billion private firm that sells collectibles and sports league apparel and runs a sports book where Coulibaly has placed bets. Coulibaly says that the company has hosted him at special VIP events attended by athletes. It's kind of just being part of their ecosystem, he says of his embrace by Fanatics. Asked about the company's relationship with him, a spokesman said he was a user of its gambling platform and didn't respond to follow-up queries. Barron sought comment from all of the individuals identified as clients on his e-commerce pitch deck for whom contact information was available, either directly or through an agent. All either declined to comment or didn't respond to messages. It wasn't clear whether they know they were included in the deck. In a report submitted earlier this year to federal and state authorities, two of the players interviewed by Barron's alleged that Coulibaly sold them an unregistered investment for a business that generates no actual income, seemingly relying instead on new participants to pay existing ones. The report, sent to the Securities and Exchange Commission, the Federal Bureau of Investigation's Philadelphia office, and the Pennsylvania Department of Banking and Securities, was filed by Barry Minko, a convicted fraudster turned freelance investigator of financial scams. Minkow is working the case for a share of any recovered funds above the investors' losses, according to the report, which was viewed by Barron's. The SEC, the FBI, and the banking regulator declined to comment. Barron's examined the mechanics of the alleged fraud through conversations with the former athletes and by viewing contracts and Shopify merchant dashboards. In exchange for investments of at least $50,000, Coulibaly offered the athletes the opportunity to become the owners of ready-made e-commerce sites. He guaranteed investors a return of their principal after 6 months, plus 80% of any profits from the sites. After the investment was made, Coulibaly provided shop owners with Shopify logins to access their store's internal dashboards. The dashboards, which were filled with fake entries, gave the appearance of healthy businesses. The websites became the first phase of a longer recruitment process. The Daily Prod Trend owner says his store's seeming success primed him to place an even bigger bet with Coulibaly when the entrepreneur presented him with what he described as a yet more lucrative opportunity involving Dubai investment firm Middle East Venture Partners. The returns from that deal haven't materialized. Coulibaly told Barron's that his investors haven't gotten returns from the deal because he himself hasn't received expected funds from Middle East Venture Partners. We're trying to figure out, what's going on with you guys, he says of the firm. We're not really sure if they're going through some financial issues currently. Middle East Venture Partners didn't respond to requests for comment. In his Instagram feed, Coulibaly poses with athletes including Nakobe Dean and Jalen Carter, both members of the Philadelphia Eagles Super Bowl championship team from 2026. An Instagram account for Motion Apparels features Dean and the multi-platinum selling rapper YG promoting the brand's designs. Dean and Carter, along with fellow former Eagles champion Terrell Edmonds, have also been frequent commenters on Coulibaly's Instagram images, posting sparkle emojis and other flattering reactions to his posts. Mark McKenzie, who played for the U.S. men's national team in this year's FIFA World Cup, has also posted on Coulibaly's feed. He says he met Edmonds, now with the Las Vegas Raiders, by chance when the two were waiting for food deliveries outside an apartment building where they both lived. Edmonds introduced him to Dean and other players. As soon as we clicked, it was like one of those things, Coulibaly says. It was like a match made in heaven. Edmonds, Dean, Carter, McKenzie, and YG are named as clients on the pitch deck for Coulibaly's e-commerce venture. An agent for Dean declined to comment. Representatives for Carter, Edmonds, McKenzie, and YG, whose birth name is Keenan Jackson, didn't respond to messages. Dom DeSandro, An Eagles official, whose wide-ranging portfolio with the team encompasses player security, vetted Coulibaly when he began socializing with players and afterward extended him an open-door policy, Coulibaly says. Coulibaly says he met Keem, the former Arizona Cardinals manager, through DeSandro, who's known locally as Big Dom. A person familiar with the Eagles told Barron's, claims regarding Dom DeSandro facilitating access to the team and other individuals for the purpose of pitching investment opportunities are completely false and contrary to the purpose of his role with the team. Keem, that's K-E-I-M, had spent 10 years as general manager of the Arizona team, later becoming an executive with Clutch Sports, which was founded by superstar sports agent Rich Paul and is now part of United Talent Agency. Keem no longer works for Clutch, a spokesman told Barron's. In his chief operating officer role with Motion Ventures, Keem coordinates with factories and vendors, as well as helping vet potential new clients, says Coulibaly, who told Barron's he owns factories in Shenzhen, China. The Lux Lane owner says Keem joined a video call last November with Coulibaly, in which the two persuaded him to invest $200,000 as part of the deal with Middle East venture partners. He says he's interacted with both men, seeking long overdue returns from the deal. The two other athletes who spoke to Barron say that they participated in separate video chats on which Keem joined Coulibaly to promote the Shopify store venture. An Instagram account with Keem's name and photo, skeem72, left a comment on an August 2025 photo from Coulibaly's feed showing the entrepreneur on a tarmac with a Gulfstream private jet. Rich, the skeem72 account wrote. In his reply, Coulibaly seemed to include Keem in his success. We, asterisk, he wrote. Another photo on Coulibaly's feed from March of 2026 finds him with an arm draped over the shoulder of Michael Hermelin, president of Fanatics' VIP program for top users. Other images show Coulibaly at what appears to be the same event with rapper Travis Scott and the comic known as Drewski. Coulibaly described Hermelin to Barron's as his main contact at Fanatics, whom he met through a friend, a big gambler. In May, Coulibaly attended the Fanatics-sponsored NFL Rookie Premiere event with the NFL Players Association, he says. The Los Angeles event included a party at the home of Fanatics founder and CEO Michael Rubin, he says. The Fanatics spokesman didn't respond to questions about Coulibaly's participation in Fanatics events or his interactions with executives. Over 10 days in mid-April, Coulibaly posted on X about a series of wagers made on the Fanatics sports betting platform. Screenshots of his betting slips showed more than $800,000 in payouts from roughly $7,000 wagered across several baseball and basketball parlay bets. The images of the betting slips were reposted by Fanatics Sportsbook to its 200,000 followers on X. Home Run King, the betting platform wrote in one post. Generational run, in capital letters, it said in another. Coulibaly told Barron's he placed the bets with credits that Fanatics awarded him as a member of its VIP program. I rarely bet with my own cash, he says. The retired NFL player who owns the Daily Prod Trend store told Barron's that he connected with Coulibaly in June of 2025 after a referral from a friend. He says Coulibaly sent him the pitch deck for Motion Ventures, which, according to the document, runs online storefronts for clients, handling everything from social media marketing to manufacturing store inventory. In multiple identically worded contracts viewed by Barron's, investors are told that their stores will be run with Facebook ads, TikTok ads, and influencer campaigns, X ads, Pinterest ads, and Instagram ads. Buried in Daily Prod Trends administrator menus, a trove of data suggests no traffic has come from such sources. The dashboard shows 90 visitors to the site from March 2025 to February of this year. More than 360 orders were recorded over that time. Those transactions were entered manually into the store's sales log by someone with access to the site and then marked as paid minutes later. Shopify's manual entry feature is for rare situations where customers don't use the platform's online ordering system. and instead phone in a purchase or pay by check, says Edwards, the cybersecurity expert. In this case, the feature appears to have been weaponized to mislead investors, Edwards said. Shopify didn't respond to questions from Barron's about the manual entry feature and its potential for abuse. Barron's sent messages to multiple email addresses searching for customers on the sales logs. All bounced back with mailbox unavailable errors. Barron's also interviewed the current resident of the Luxembourg home, listed as the shipping address for the humidifiers and cup warmers purchased from Daily Prod Trend in February. The resident, who replied to a mailed letter from Barron's, said he had never made such a purchase. Koulibaly said purchaser details are masked online to protect his customer list. In May, this reporter used his own name and Barron's New York City address to place a test order, $14.99 for a waterproof smartphone bag on Daily Prod Trend. Barron's then used the owner's dashboard to check the sales log. This reporter's name and address appeared without any alteration. As of this article's publication, the smartphone bag hadn't been delivered to Barron's. It remains marked unfulfilled on the site's order log. The investor in Lux Lane says a pair of cake molds that his wife paid for on the site haven't arrived after 2 months, so he brought the matter up with Koulibaly. A couple weeks later, I get one cake mold at the door, he says. As the orders piled up on the fake sites, Koulibaly told his athlete investors the business had attracted new interest. Middle East venture partners had agreed to purchase his motion ventures for $215 million, he said, once it had grown to operate 175 online stores. Cash from the deal would be dispersed as more stores were established, he told investors, offering them a big cut on those proceeds in exchange for funding blocks of new sites. As evidence of the deal's legitimacy, he showed the athlete a contract between him and the Dubai firm. That contract, viewed by Barron's, named a J.P. Morgan Chase wealth advisor as escrow agent. Chase said in a statement to Barron's that the escrow contract didn't come from the bank. The signature in the document doesn't match the advisor's signature, it added. Before investing, one of the athletes interviewed by Barron's had a contract for the deal reviewed by an advisor at Florida-based Matador Financial, which markets itself on its website as a specialist in athletes' finances. And after reading the document, the advisor said that everything was, to his knowledge, legit, the second athlete told Barron's. Hayes, the advisor who separately reviewed the contract at Barron's, said that its grammatical errors, terminological inconsistencies, and guarantee of a 100% return after 2 months should have been red flags. Wow, Hayes said in an email. Our vetting and due diligence would have revealed enough that we would have advised against any participation in this scheme. Matador didn't respond to messages from Barron's. The Daily Prod Trend owner and his friends say they invested $925,000. New cash plus returns they believe they were owed by Koulibaly to set up 18 stores, and they were told to expect double that amount back when the deal paid out in December of 2025. As that date approached, however, Koulibaly persuaded them to accept increasingly complicated new terms that obligated them to invest nearly $300,000 in additional cash. In exchange, they were told they'd receive a dramatically larger return, about $4 million, which would be released in increments with the bulk of the payout coming in March of 2026. The two say they became suspicious when the first disbursement didn't arrive and began working with Minco. In a February text message to an investor viewed by Barron's, Koulibaly blamed the delays on a banking glitch. The exchange suggests that banks may have had concerns about his use of his accounts with them for his businesses. Bro, we had Chase, but they were bullying us because of the amount of money we'd moved, so we switched to Wells, he wrote in the text. And they're bullying us too. The Chase spokeswoman said the bank doesn't maintain accounts for Koulibaly or his businesses, but was unable to share additional account details due to privacy rules, and a Wells Fargo spokesman had no comment. Late last month, the Lux Lane owner says that Koulibaly again promised him a payout from the Middle East Venture Partners deal. This time he attributed the delays to hostilities between Iran and its Middle Eastern neighbors. And yes, the payment has yet to arrive. And with that, we've come to the end of our reading of Barron's Magazine with an issue date of July 20th, of 2026. This is your reader, Eric, saying be well, be safe, look after each other. Bye for now.